Today's
Hello.
topic, oh, sorry.
Oh, hi everyone. Good morning. This is Partners in Business with RC Thornton and Advanced Auto, and Robin is going to introduce herself. Hello, Robin.
Hello. Today's topic is cost segregation, a tax deduction to write home about. As she said, my name is Robin Couture. 28 years ago, Paul and I started Advanced Auto Service and Tire Centers. Today, we have 15 locations throughout Arizona that sell tires, custom wheels, and provide complete automotive service. We are long-time customers of our speaker. Years ago, our speaker educated us about the opportunity and advantages of using cost segregation, which is a tax reduction technique that has actually been around since the year 2000. What is really surprising is that most business owners don't even know about it, missing out on a powerful tool to get greater deductions on their real estate. If you own business real estate, it is something you should consider. In fact, our speaker told me that it is not unusual to save $75,000 and more in taxes by doing a cost segregation study on just one building. We found that to be quite true, actually, and were frankly surprised by how much money we saved in taxes. However, there's more to this than merely getting someone to do an engineering study so you can get a greater deduction. It is important to consider when and how that deduction should be used. Chuck Thornton is our speaker today. He is a CPA located in Phoenix, Arizona, with a master's degree in taxation from New York University. He and his entire firm have a major mission. Their mission is to help clients keep more of what they are working and living for. Said differently, that means saving taxes. In his previous life, he was an IRS agent, although he asks you, please don't hold that against him. He has published tax articles and a book called Hard-Hitting Tax Strategies for Corporations. Many CPAs, both locally and nationally, know him because he has made numerous presentations to them. I know you will enjoy this presentation, so let's get to it and welcome Chuck Thornton.
Well, Robin, thank you very much. I appreciate that. And welcome to our people listening in on our webinar for cost segregation, a deduction to write home about. In fact, I will be kind of once in a while be saying something to Sarah, who's the person running our slides right now. I'll be saying like next slide because she's in the control of the whole thing. But a tax deduction to write home about, that's because a lot of people don't know about this. Even though it's been around since 2000, that means it's been around for 17 years. There's still quite an amazement that a lot of people have not used this technique on their building. Next slide, please. Of course, as you know, we're sponsored by Advanced Auto, and I appreciate that, Robin. And let's go to the next slide. And there's a little bit more background about us. You'll be able to access some of this information. And so now let's go ahead and start the seminar. Next slide. Okay, tax savings commercial property. It's a lucrative tax strategy that should be used in almost every major purchase of commercial real estate. That's from the Wall Street Journal, 2003. The reason we keep on saying this has been around since 2000 is there's actually a specific revenue procedure that the IRS came out with basically sanctioning this in the year 2000. So it took the Wall Street Journal 3 years to find out and start writing about this, but it's been around for a long time. Next slide, please. Okay, here's some real results. And so far, I haven't really told you what this is. Stay tuned. We're going to talk about what the cost segregation is. But I went through some clients of ours, and I just kind of took a look at what the tax savings were. I'm not going to read everyone in there, but there's a big one, contractor, who had quite a large warehouse building, $325,000 in tax savings in the year that he decided to use what's called cost segregation. A medical group of doctors, 229,000. The smallest one was a dentist with a sole practitioner that had a building that he paid, I think it was around $100,000 for, and in the year that we did this was $82,000. Where do these guys put their savings? Well, most of them put their money back in the business, but we confess one purchased a nice vacation home. I'll let you decide who that might have been. Next slide. Okay, so what's cost segregation? You know, once we start getting a little technical, it can be a little boring, and I'm going to ask you to hang in there. I don't want to make this boring, But when you see the results, it gets pretty exciting. In fact, I think that guy that has this new car there probably did a cost seg study. Next slide, please. So what is it and why do we care? And now I'm going to talk accountantese for you here. Depreciation is a systematic charge of property over a period of time. So when you buy a building, we all know there's something called depreciation. You probably don't necessarily know how it works, but there's something about depreciation. They let you recoup some of the cost over a 20-year period. Example, if you have a $500,000 building, you get $25,000 depreciation per year if it was a 20-year. Now, I'm not suggesting that's a building. I'm just saying any type of property as an example. But systematic could mean something more than just straight line. It could mean taking a $500,000 item and getting $300,000 the first year, and you could go through that, one half of it the first year, and then what happens is then you amortize the rest over 5 years to get 300. Don't worry about how I got that, but the point I'm getting to is the word systematic doesn't always mean straight line. So which one of those deductions would you want? Would you want $25,000 the first year, or you rather have $300,000 the first year? Next slide. Here's what the typical accountant does. And when I say typical, I certainly don't have any survey on this or articles or anything, but when we do start with new client relationships, this is almost always what we see. The traditional wisdom is, yeah, you just take 80% of the cost of the building, you take 20% allocate it to land, and then what happens is that you look up on the tables and you say that 80% of the building is, if it's residential, it's written off over 27.5 years, 39 years for commercial, straight line, and that's the way it goes. So therefore, if you remember that last slide, you're not getting much depreciation. This is taking a long, long time, basically, to get a deduction for your building. A more proactive approach might be is to say, well, why don't we allocate some of it to 15-year property? Why don't we allocate cabinets and carpentry to 5 years property? And I do see some accountants do that, and that's called a desktop cost segregation. It's very basic. We say, well, the parking lot maybe cost $25,000. We might say the cabinetry and stuff in there cost X number of dollars, but it is just a scratch on the surface. So your desktop segregation, kind of done ad hoc, is certainly better than taking the building, say, over 39 years, but it's nowhere close. I mean, it's remote to compare what will cost segregation. You might literally save hundreds of thousands of dollars with cost segregation. Next slide. So let's just use an example here. I just want to show you magnitudes. If you're not following my computations, in fact, I'm deliberately not trying to get too much into computations, but a building cost of land not included with $2 million, meaning maybe the building costs 2.4, but the building written off over 39 years. Versus if we could take 25% of that building and we could allocate it to 5 and 15-year tangible personal property, I'm building on the concept here, then my additional first-year tax savings is the deduction is $300,000, and my extra cash flow in my pocket is $120,000. I'm deliberately not showing you how I got those numbers, but I do have my spreadsheets for that. So I'm just saying by allocating 25% of your building to tangible personal property instead of real estate, I might save myself an extra $120,000 in the year that I do this. Next slide. So how can you do this? I'm starting to throw around this term called personal property. And here's the trick on this whole thing. Personal property under local law is not the same definition as personal property is for tax law. This is where people get thrown on this, because we all know that if you sell your building, the carpet, the cabinets, all the items are fixed to the property, generally will go with the real estate, so everyone says it's part of the real estate. But for tax purposes, this personal property is now defined under, I'm just going to use this section 1245 because that's the lingo. So from now on, I'll just say 1245 property, and that means the IRS's definition of tangible personal property. And if I can get something in that building to be called 1245 property, the depreciation is faster. I can get it as over as little as 5 years, maybe 15 years. But if I can get over 5 years, I might get half of that portion of that 1245 property in the current year, which was that prior slide that we have. But again, a majority of accountants fail to take faster depreciation, and they usually take it over 39 years. Next slide. So what is 1245? Very briefly, it's property subject to depreciation, personal property, and it is property that is not inherently a permanent structure. And there's lots of cases on this. We won't get into too much of this, but the cost segregation people go in and they'll say, what in this building is not inherently a permanent structure? Well, the basic ones, obviously carpet, cabinets, but there's other items in the buildings too, like glass, as an example, drop ceilings and things like that, that are not inherently a permanent structure. You can move them around. They're not made to be permanent. They're intended to be replaced easily in a period of time less than 39 years. Or other property used as an integral part of the manufacturing or production process. So electrical systems in restaurants that are designed to deliver high load to the stoves, a manufacturer of steel fabrications, lumber, and things like that, who have special lines and power put in that are used for their machinery, that would be an integral part of the manufacturing and production process, even though under local law, that's real estate. Under tax definitions, that's 1245 property. Next slide. Okay, just a couple examples. 1245 property could be electrical outlets, decorative rock work, floor covering, sheet vinyl carpeting, decorative light fixtures, decorative carpentry, strippable wallpaper, paint booth, and fabrication of a facility. So those are just a couple examples I just kind of thought real quick, but here's something. In visiting with cost segregation providers, looking at some literature, there is a suggestion by many that you might actually get 25% of your building might actually be 1245 property. So my example, where we had a building with $2 million, 25% of that could be $500,000. And depending on what year the rules are written, you might actually get able to write off that $250,000 plus the 50 for the current year. That was my example for the 300. Much, much better than taking that over 39 years. The trick is, how do you allocate these things out in a way that's supportable with the IRS? Next slide. Now, even though the IRS sanctioned this back in the year 2000, and they have yet to change. There's court history and history behind this, which I won't get into why they did that. They certainly realize that people can just say, well, everything is 1245 property. And so there is an Internal Revenue manual on this, which we have studied quite extensively to see what their positions would be. But they look at these rule of thumb. It's a guess approach that some accountants might use. And they warn them, the auditors, the IRS warns their auditors, view this approach with caution since it lacks sufficient documentation to support the allocation of project cost. See, you know, the burden of proof is always with you. So when you step up and say, I want to take this cost segregation, I believe that $500,000 of this is 1245 property, the burden is on you to prove it, not the IRS. So therefore, the Internal Revenue Manual discusses for the agents and anyone who happens to want to read it, what are the issues, what's the burden of proof that you have to meet to basically be successful, unless, of course, you want to go through some type of court system, which is not what you're trying to do. Okay, next slide. Now, so we get into, now you have to be able to have a cost segregation study to provide your evidence. But there's other things that can go wrong. So you can have a great cost segregation study, and this whole thing could go wrong anyhow. I'm just going to give you a couple examples why I say it could go wrong. This is just the tool. The tool is, here's what the depreciation is. The question now we have to take a look at, as the accountants, is there an alternative minimum tax implication on this? What type of entities do I have? Do I have things called bases and at-risk limitations? Do I have too many deductions? Should I really be taking all this in the current year? If you have several buildings, maybe we do one year and one the next year. And if I'm leasing to my own business, are there certain elections that I need to make so that I didn't create a large passive loss? Now, if you followed all those technical things I said, you probably should be an accountant. If you didn't, I just want to illustrate to you the confusion of there's a lot of issues that you have to deal with. As an example, in our opinion, because we've done quite a few of these, the alternative minimum tax basically clobbers about 20% of these reports and makes them not worthless. Makes them worthless. The need to make certain elections comes up 85% of the time. And could we be taking these in different years to optimize it? Comes up about 20% of the times. And the type of entities and the ownership winds up being issues 25% of the time. Now, the person doing the cost segregation study, they're gone. Here's your report. Do what you want to with it. But you ought to really know these answers before you even buy the report, because it may be this isn't the year to do it. Maybe you need to do it another year. Maybe you need to straddle those buildings different years. So there's a lot of brain thinking that goes on as to do you want the report and how are you going to use it. The folks doing the reports, they don't consult on this. This is the accountant side of what we're talking about. Next slide, please. Okay, so now to get this started, you need first to kind of get someone who's going to come in and say, we do cost segregation studies. Most of the people who do these will come in and they can give you some general idea of what they think the end result of their report's going to be. And usually they can tell you within 10% because if they've done enough studies, they have a tremendous database for this. So they usually do this under a no-cost approach, giving you preliminary information. It's time now to visit with the accountants to figure out, do you even want to do this report? But I want to caution you that there are so many people out there doing cost segregation studies. Test it out yourself. I Googled cost segregation, gave me 3,170,000 hits, and I Googled cost segregation provider, I got $216,000 hits. I'm sure if I said cost segregation provider Phoenix, I would probably get less hits, but there's lots and lots of people out there wanting to get into the business that wants to do your cost segregation. You get a good report, you get a bad report, that is on you with the IRS because the burden of proof is on you. And if these reports aren't following some logical aspects of the Internal Revenue Manual, your whole report may get thrown out. And believe me, they have their engineers on their side that will look at the reports and make a decision as to whether your report that you got for this is worthwhile. Now, if they say it's not, it doesn't mean you can't fight this. It doesn't mean you can't go to court, but you're sure eroding the benefits of having to spend accounting and legal fees for this. The burden on you is to get the right cost segregation study company in the first place. Okay, next slide. Okay, so we're going to select some companies. There are several things to ask. Do they use a rule of thumb? If they say yes, end the conversation. We've already talked about that. How factually intensive are the reports, and are they supported by corroborating evidence? In other words, you might ask to see a copy of a sample report that they've done in the past. And also, too, are the people who are doing the work, who are they? Are they construction estimators? Are they people who've been involved in the construction business? So I would say someone who's been in it for a while, there's particular software they have to use, but we won't get into that. In other words, are they qualified individuals? And then are they pretty knowledgeable of the Internal Revenue Manual? Next slide. So, with care and competent advice is the best thing you have to do. Providers of cost segregation often will approach you. You'll get mailers, you might get a referral, but typically the way they get their business is they approach you. Most are not CPAs. They don't know your situation. They can't even provide you a candidate assessment of whether you need one or not. Their job is to either do a report or not do the report. They don't even pretend to give you advice to your own situation. So now the question is, what about the advisor that you're using to help you in this area? The questions you need to be asked is, have they been involved extensively with the use of cost segregation? I mean, have they really analyzed the issues, basis, alt-min tax, all those things that we're talking about? Have they really done that? You can usually find out very quickly by just asking them, how many of these have you been doing with your clients over the last 2 or 3 years? And if you hear phrases such as, well, we're starting to do this, it's interesting, you're the first one, those are some pop-ups that you might want to consider. Do they know the criteria that should be used in the selection of cost segregation study? Are they familiar and have they read the audit guide? Simple questions like, what IRS guidance is there as to how to select them? Their answer should be, there's actually an Internal Revenue Manual that gives you suggestions on quality cost segregation providers. The IRS doesn't tell you how to select them, but they just say, here's what they look for, which is what you should be looking for also. Okay, next slide. So one of the things we had earlier in the game here was I gave you some results here about some of our clients and people we worked with. And I think a logical question to ask is, those look like nice savings, but what kind of investment do I have to make to deal with all that? I'm just going to give you one. I'm going to pick on the one that saved $225,000, internet local retailer. He had basically 3 buildings, and the cost segregation provider's fees was $18,000. Actually, our fees on this wasn't very much. We just simply go through and analyze whether they should do this, all those accountant type things we did. We have our software all geared for this to do this reasonably quickly. Our fee was around $3,000. So his total outlay was around $21,000. Keep in mind it's deductible. So therefore, the cost by the client after taxes was $13,000 after taxes. So 21 is a $13,000 net cash out of his pocket because he would pay something to the IRS. I did a little calculation here. $225,000 savings for a $13,000. My calculation is that's a 1,730% rate of return on your investment. I think that's a pretty good deal. Okay, next slide. Do CPAs generally advise on cost segregation studies? Now, I'm making the distinction between people who do the reports versus advising and strategizing how you're going to do this. Some undoubtedly do. We believe, however, that most do not. Most have little knowledge of this. They have not made this a study. It's a little bit of a niche in itself. I would like to tell you we're the only ones out there, but we're not. There's a few others out there who do it, but it's not typically the typical CPA who gets involved in this area. Next slide. So, does R.C. Thornton and Associates do cost segregations? No, we don't do the studies. Maybe you're surprised, maybe you're not. That is not what our value proposition is, because we know that there are good providers out there. We know that there are not good providers out there, but we know that you have to have some type of quality architect, engineer, construction. You have to be geared up to do these reports and to be pretty good at it. That's a discipline that there's enough supply out there that for us it didn't make sense for us to get into doing cost segregation studies. And I would submit most CPAs would not even dream of doing a cost segregation study unless they have made a commitment to hire the kind of people to do this. And very few would do that. So next slide then. So how can we help you? Well, where we can help you is in that area where we advise on whether you need one, whether you, how to find a cost segregation person, and how we go through the minefield of those basis limitations, those elections, those things that the cost segregation people are not going to be giving you, and go through the passive issues, go through the alt-mint. So what we do is we help you in your selection of your cost segregation provider. We're independent. We don't get anything back from these folks at all. We just know the questions to ask, and we do have a few that we seem to favor, but we're certainly open to other ones. But we do our homework. We want to see sample reports. We sit down, we interview these guys. How do you get this information? We sample certain things about the Internal Revenue Manual to see what techniques and methodology that they're using, so we can sort out the people that says, we think they're doing the kind of work that you'd be able to provide evidence for your cost segregation. We can also help you properly implement this with your tax return. This isn't over to your tax returns filed, meaning that all these strategies, all these basis limit, all these basis limit, passive, all these other things we're talking about need to be resolved up front, but they need to also be done on your tax return so you have the proper filing. We've worked in many cases with the clients over the years, and we got solid results, hundreds and hundreds, if not billions of dollars of tax savings for clients. Next slide, please. So, my name is Chuck Thornton with R.C. Thornton and Associates. There is my email. There is my phone number, the information. Please give us a call if you have a building. If you just want to chit-chat, and that's as far as it goes, that's fine. You'll probably pick up a little bit more valuable information just from a chit-chat. If you think we might be the right group that can help you in the cost segregation endeavor, all the way from finding a cost segregation person for you, all the way to analyzing your situation, and if you'd like, having us making sure it's properly reported, we can help you on that also. And with that, we're going to close out, and we sometimes have questions and answers, which we're going to do here in a moment. However, we will now turn off the recording, and the reason for that is that sometimes people want to ask questions, but they don't exactly want it recorded. So, Sarah, if you would just take a moment and turn off the recording.